Hello and welcome. You're watching The Money Show and I'm Kavitha and this is our very special edition of World Investor Week. Yes, you heard that right. World Investor Week 2025 is a global campaign being celebrated under the aegis of International Organization of Securities Commission and SEBI from October 6 to 12th October to raise awareness about the importance of investor education and investor protection. ET Now, as you already know, has always looked out for the investor, and keeping in line with the channel's ethos, we will be creating special programming for World Investor Week from 6th to 11th October. So all you have to do is just tune into the Money Show at 5 p.m. on ET Now every day this week to hear from experts who will share actionable insights on how investors can better manage their personal finance portfolio, and we will be bringing the special programming to you with our banking partner, State Bank of India. So let's begin. And today let's talk about a fascinating report from HDFC True titled The One-Year Return Trap. And let's look at it, what highlights the report has to say. And it actually highlights a lot about investor behavior and its connection with returns on investment. So what's the big warning here? Don't chase mutual funds just because of their recent one-year high returns. But don't we all know about that? And if we do, how many of us actually follow? But let's look at what the report has to say. The report says short-term outperformance often inflates multi-year averages, and that can completely mislead investors about a fund's real sustainable performance. In short, the fund that's on top today may not stay there tomorrow. Let's explain you the actual trap that's highlighted in this report. Here's what happens. When a fund does exceptionally well in just 1 year, maybe because a few stocks in its portfolio rallied, that 1 year gain gets folded into its 2 year, 3 year, even 5 year return. So suddenly it looks like a great thing across all time frames, even though that success came from just one single good year. Let's also look at an illustration that's given in the report. The period that's taken is from 2021 to 2025. There's Fund 1 and there's Fund 2. Fund 1, consistent performance from 21 to 25, 15%. Now Fund 2, in the year 2021, 10%. 22, 14%, 23, 12%, 24, minus 1%, and 2025, 45%. Now, if you see the number as of 2025, Fund 2 looks much better. But that's just because on the 45% jump in 2025. Fund 1, meanwhile, has been steady at 15% every single year. So, who's the real performer, the consistent one or the lucky one? The report calls this the one-year trap, where recent winners are often lucky or cyclical, not superior managers. Now, to test this theory, HDFC True ran a massive 20-year study from 2005 to 2025, covering 32 large-cap funds, 30 flexi-cap or multi-cap funds, and 29 mid-cap funds. And then they tested two very real-world scenarios. First, they imagined an investor who every year picks the top performing fund from last year and invests in it for the next 1 year. After doing that for 20 years, the result was surprising. The top ranked fund gave about 14% CAGR, but the 6th ranked fund gave a higher return, about 16%. So in other words, there was no pattern. Future performance turned out to be completely random, unrelated to last year's ranking. So chasing last year's chart topper didn't give better returns, clearly. Now let's take the example of test 2. A longer time horizon, and this time with a 3-year-old holding period. Every year they invested 100 rupees in the previous year's rank 1 fund and held it for 3 years. Comparing results across ranks. Year 2, the results told the same story. In large cap funds, the rank 1 fund gave around 13%, while the rank 3 gave better, around 15%. In mid caps, rank 1 gave 13%, but a mid-ranked fund between rank 4 and 6 almost gave 17% returns. Now, even in flexi or multi-cap funds, there was no consistency, pure random dispersion. So, even with a longer time frame, past 1 year performance didn't predict the future success. So, what's the conclusion? The HDFC True study makes 4 clear points. Recent outperformance artificially boosts long-term returns. High 1 year return do not mean the fund is consistent. Ranking based investing simply doesn't work. Last year's top fund rarely remains a leader later. And most importantly, investors should focus on long term consistency and process, not short term glamour. In simple words, don't get seduced by a mutual fund's best 1 year return. That performance often fades. Instead, look for funds who deliver steady returns year after year, follow a disciplined investment process, and also a process, where the entire portfolio or funds can survive both bull and bear markets with equal resilience. So, past 1 year performance is a mirage. Don't run after the latest winner, because in investing, consistency always beats flash. So that's the 1 year return trap explained to you. But let's go deeper, and let's invite our guest to understand this report and the kind of investor behavior attached to it. I have with me the man himself, Dhiraj Relli, to help us decode the report more, analyze the investor behavior. I'm joined by Kavitha Menon. Thank you so much and welcome both of you to this very special edition of World Investor Week. Let's begin. And Dhiraj, first question to you. We saw the report. We understood the report as well. But now the question that came in my mind is, are we looking at chasing last year's return top mutual fund the way the report says? And are we talking about investors dabbling with funds the way they do in stocks?
So, Kavitha, you have articulated and summed up the report very well. I think the objective for us to come out with this study and highlight the mirage of 1 year returns is that, most of the distributors and customers are looking at short-term performances and are in a hurry to decide the fund based on only the recent buyers, recent performance only. So that's where we thought that we should come out as a credible brokerage house, as a credible advisor, HDFC True. We should come out and do a detailed deep dive into this subject. And that's where we looked at 20-year data, and we found that there are no merits in chasing these short-term returns. One should look at in a fund that has a more consistent performance. In any case, past returns are no guarantee of future returns. So how do we choose a fund? That's something very, very critical. And I'll add another dimension to it, which is not covered in this report. There is something called tax deferred taxation benefit also. If you keep churning your portfolio, you end up paying taxes on your long-term or short-term capital gains on the funds. Whereas if you stay invested for long-term, let's say 10-year, 15-year in a same scheme, you are getting the benefit of compounding, and there are no taxation till the time you redeem the funds. So to that extent, also you end up multiplying your capital and gain more returns. In fact, I was looking at last night data for 10 years, and if you look at the 10-year returns, the difference comes to in a CAGR about 70 basis point. That 70 basis point difference is if you invest if you keep booking the profits and pay taxes, or if you stay invested for 10-year period. This 70 basis point, if I have to translate into a real number, for a 1 crore investment for 10 year, translate into a incremental returns of 23 lakhs at when I'm calculating these returns at a 15% CAGR. If I do this at a 20%, which is unlikely, 15% is a more credible number. But just to illustrate my point, this will be somewhere, the impact somewhere will be about 52, 53 lakhs rupees. So there are merits in doing a fund selection based on the consistency of the fund performance. When you're looking at the performance of the fund, you look at what is the composition of their portfolio, what are the earning potential of this portfolio, how resilient they are to the various market cycles, and also what is the track record in terms of navigating the sector selection and stock selection, and also how these fund managers have track record of 10, 15 years. That's where it will give you a much better perspective rather than, going for a recent performance bias.
Time for a quick break. We'll be back soon. Welcome back, and you're watching a very special episode of The Money Show on World's Investor Week. Kavitha, let's also understand, how does a single strong year inflate a fund's 3 year or 5 years return?
So the report is actually quite well illustrated this point. So just assume that I have done a very average 5 to 10% return in 4 years. And in my the fifth year, I do a 45, 50% CAGR. Annual return. So what happens is in this, this illustration shows it very nicely that my average 5 year return starts looking so brilliant. It looks so nice because, it suddenly looks like a 15 or 20% return on investment on a 5 year basis, on a CAGR basis. While actually most part of the return came only to those investors who probably invested in the last 1 year or stayed invested in the last 1 year. I'm a investment advisor, so we don't do our research based on 1 year, 3 year, 5 year returns. Point to point returns is what it is called. uh, for investors also, this is for the benefit of your viewers. There are ways in which you can come out of this trap when you are looking at performance. We look at rolling returns, which is the every 3 year period in which the fund has performed, or every 5 year period in which it is performed, or every 1 year period in which the fund has performed. We take an average of that. Rolling returns is a far better indicator of fund performance than point to point returns. Unfortunately, most fact sheets, most of the data that you see online is point to point data. And it is only in this kind of data that the last year's performance will heavily weigh on the fund's overall performance, which is where rolling return comes in. And it is a far superior way of evaluating returns. There is another trick that you can use, and this data is available on fact sheets. It's very easily available. The other one is to use standard deviation as a measure of volatility. This will give you an indicative understanding of how the fund's performance has moved over the mean in a period of time. It's a very good indicator of volatility and whether you can absorb it. More volatile, more higher the standard deviation, it means it's likely that the fund is going to go up and down a lot more, and therefore give you a lot of stomach churning discomfort. Okay, so standard deviation. And there's another measure called Sharpe ratio, which is an indicator of the uh, additional return that you're getting for the risk that you take. These three measures, I'm just giving you the three very basic numbers that you can use if you have to evaluate funds rather than looking at point to point returns.
Right. So
I think I'll
that
just add to
sure,
it. The
sure,
point
sure.
to point return is something where we see the skew, and it is both ways. It is not just for the outperformance, it could be underperformance also. A fund
Yes.
manager who have been doing consistently great job, but in last 1 year, for certain choices, the fund may not have done well, and that can also lead to a significant dispersion. So to that extent, this will skew both underperformance and overperformance. So don't look at the short-term returns is something we have highlighted and corroborated and through this report.
All right. Dhiraj,
Kavita, I want to add
sure,
one more thing,
sure,
just
sure.
a little
Yeah,
thing here.
yeah,
This report is really timely, because in the last
exactly.
4 to 5 years, thanks to access to platforms, which are, at a click of a button, you can make an investment, start a
Absolutely.
SIP, etc. So the
Yeah,
young generation has been doing this do-it-yourself kind of investments, right?
yeah, yeah.
And what is the number they check? They check exactly this, the last 1 year return, the last 3 year returns. And exactly
Absolutely.
this is where they go
Yeah,
wrong. And
yeah.
now, after a year of where the markets have consolidated, they have started panicking.
Panicking.
Oh, my
True.
returns are negative, and it's not like,
Right.
where do we do? What do we do?
What do we do?
So, yeah.
Absolutely, absolutely. So one thing over here, Dhiraj, you can just elaborate on this. I want to talk about the ranking system. Don't you think mutual funds ranking system also should show consistency scores instead of just returns?
I think it's got to do more with the distributors also. Distributor
Okay,
also select
okay.
most of these funds based on the point-to-point returns only. And even point-to-point returns of 3 to 5 year can also be skewed by 1 year performance. So to that extent, this is a suboptimal measure. That's what we are trying to prove. So you have to look at larger criteria rather than looking at only just the performance of 1 year, 3 year, or 5 year. You need to look at the track record of the funds. Kavita highlighted that one can look at rolling returns. Again, it could give you a very good pictorial graph on how the returns are there. You can do 1 year rolling return. You can do, a 1 day rolling return 1 year. You can do 1 day rolling return for 3 years, 5 years, and so on. But other than that, I think it's the fund management style, their quality of their portfolio, how they are navigating different cycles of the business, what kind of sectoral allocation they have, and what kind of mean reversion is possible in their portfolio. Those are the parameters one should use while analyzing particular scheme. That's where I think the role of advisor come into the play, and that's where the independent advisors can help you to choose the right funds.
Over here, I think, Kavita, even the stakeholders, so if ranking based investing doesn't work, why are AMC ads still built around short term numbers?
It's a good question. The AMC business is an asset gathering business more than an
Absolutely.
asset management business.
That is
It's
what it looks
unfortunate.
like. Yeah.
Yes, so it's unfortunate, but it's also in a way, let's give credit where due. The mutual fund industry has been so important for getting, the population, the middle class of India to participate in the capital market. So we'll give them that credit. But yes, the focus continues to be on returns. If you look at the advertisements, they're always talking about returns alone, and that's unfortunate, but that's the way the industry is built. So for me, I always tell my investors, you have to be aware of the consequences of making choices in investments. You need to choose with knowledge and with expertise. If you don't have it, use the resources that are there. There are advisors, you can use their advice, or you go in deep and check. The data is available online. A lot of information is available today. If somebody is wanting to read and study and gain expertise, and he or she can. But unfortunately, what you will see most prominently and most spoken about will be returns.
Exactly. That is what. So Dhiraj, we can comfortably say that that this report proves that patience is the new alpha. Can we say that? Do investors prefer excitement over consistency and pay for it with lower returns? Then that is what it means.
Absolutely. There is no deep intelligence that you need or deep analysis you need. All that you need is a patience and long-term horizon for investing. While selecting fund, one can spend some energy to choose the right fund, and after that, you can stay invested. One that we have shown with the performance, another taxation benefits I have just articulated some time back. So if you combine these two, there are significant merits in staying investing for the long term. Let me give you one more comparison with the other industry. Like Kavita mentioned, that industry is becoming more asset gathering industry and not asset management industry. If you look at insurance industry, they do not compare their returns with the other insurance companies, and they do not talk about returns also. So they package their product in terms of proposition, which is returns as well as insurance embedded along with that. So to that extent, I think there is a dire need for now asset management industry to also start highlighting the proposition in a much different manner, just rather than just boasting about the returns only.
One thing I really want to understand from both of you now: should SEBI regulate how performance data is displayed to prevent the behavioral trap? Is it already happening, Kavita?
Yes, in the case of mutual funds, PMS, SEBI does regulate the way returns are being shown, and it is doing a lot in terms of getting more additional data to investors. But unfortunately, I think when it comes to point returns, we have still not gone to a place where rolling returns is mandatory and it should be shown in the portfolio. So, unfortunately, and it's a lot of data. So, let me just say, rolling returns is not easily calculated. We need software to do it. But for most part, SEBI has been amazing in terms of setting the standards for showcasing how performance is showcased to investors, how it is. Yeah, you have comparisons with benchmarks, you have standard deviation, Sharpe ratio, etc., mandatorily displayed, at least in the case of mutual funds and PMS. So
Dheeraj?
yes, it's
Sure.
already there. The standards are there.
Sure.
Yeah,
Sure.
so
Yeah.
disclosures are in place.
Hmm.
In fact, a couple of years ago, I was part of a jury to select the best performing schemes and fund managers. That's where we decided as a jury to focus on rolling returns and do away with the point-to-point returns. So there is a greater awareness on how we should start evaluating these schemes. I think it's a step in a right direction. Reports like this will also highlight, and you are doing a show on the same also shows that we are mindful of what we communicate to our target audiences and customers. So to that extent, it's a step in a right direction, and I believe now industry is at inflection point where we start talking about the proposition more than the just about returns.
Absolutely, absolutely. And as earlier Kavitha also said, the right timing for this report to come up, help investors understand the real way to invest and to look at performances especially. Thank you so much, Kavitha and Dhiraj, for being a part of this show and helping our viewers navigate their investments and the performance today. Thank you so much.
Thank you.
Thank you.
All right, so to end the show, the 1 year return trap is really a reminder of your own investing instincts. We love fast results, quick ranking, and top charts, but wealth isn't built that way. The winners of 1 year often fades the next, and the steady, consistent performers quietly create long-term wealth. So before you switch funds for the next top performer, remember, patience and process still beat performance on paper. Thank you so much for watching. Goodbye.